What is going on from a market perspective, equities, fixed income, as well as commodities. Gartman is joining us. He is, of course, the founder of the Gartman Letter, and now is a chair of the Akron University's Investment Committee. Dennis, great to see you. Thanks for joining us.
Catherine, always great to see you. Thanks for having me on.
Thank you. I read your notes, of course, prior to the show, and you seem to be very, very bearish. Give us your sense in terms of what's going on and why.
Well, I wouldn't call myself very, very bearish. I'd call myself modestly bearish at this point. I trade only from my own account, other than the responsibilities I have for the University of Akron and for NC State. But what I talk about is what I do from my own account, and I am marginally, and the operative word here is marginally, net short the manner of the equities markets on balance. Now, really, it's not too dramatically so, and I won't get more so until the market tells me that I'm absolutely right. But I've only been short since yesterday afternoon, and I feel okay about it. What I wrote to you was the fact that in bull markets, the manners in which markets tend to trade. In a bull market, you open lower, spend the day going higher, closing on the highs. You open lower again the next day, spend the day moving higher, close on the highs. That's how bull markets function. That's how they act. Bear markets trade demonstrably differently. They close on the lows, open higher the next day, spend the day moving lower, close on the lows again. And that's what we've been seeing now for the past several weeks, actually, maybe even a month or two, where the market has changed the manner in which it deals. Secondly, the public is aggressively involved in the markets. The fact that we've had so much activity on the part of those people trading through Robinhood and the rest of them, the fact that David Portnoy has become a guru. Instead of watching football games, he's now predicating his activities in the stock market, making the comment that stocks, one, only go up, and two, that this is an easy game and all you have to know is understand the alphabet and just buy stocks and buy anything, throw a dart at the board and you'll be fine. When the public gets that enamored of stocks, when the public is that involved in the stock market, I'm reminded of what happened in 1928 and 29 when Joseph Kennedy got out of the stock market in the spring of 29 because his shoe shine man was telling him that it was giving him stock tips. And it seems to be that same sort of phenomenon right now. The psychology is overwhelmingly bullish on the part of retail. I'll tend to take the other side. So instead of saying I'm aggressively bearish, let's say I'm modestly so.
Howard, investors wait on tenterhooks for your regular memos. They had a lot of them in March and April, a few, not so many as of late. You're out with another one, time for thinking. Howard, you raise a number of provocative points and questions in your memo. One of them, in some ways, states the obvious. The financial markets are at the center of a titanic struggle between the pandemic on the one hand, right, and the government effectively on the other, recession versus the Fed and the Treasury Department. And you ask which will win. You and I, Howard, have talked about this before. And as recently as May, your thinking was that the Fed couldn't keep it up forever. Am I to divine that perhaps your thinking may have changed on that subject?
No, Eric, I still don't know if they can keep it up forever. That's the critical question. The Fed and the Treasury support is obviously very important to the economy while it's partially shut down and underperforming, and the provision of liquidity by the Fed and the keeping of interest rates low. All these things are very, very important to what the market has been doing for the last 4 or 5 months and what it does in the future. And you know, the question of how the Fed has expanded its balance sheet from $4 trillion to $7 trillion in the last few months, and the Treasury has expanded the deficit from, it would have been just over 1, now it's probably going to be over 4 until they pass still more aid, which they probably will do. So the question is, how long can they keep it up? Nobody knows.
Well, is that to say, though, let's try to answer the question you raise. Which will win? Do economic fundamentals ultimately triumph over government stimulus, government policy?
Well, we've never had anything like this in the economy. You know, the GDP in the second quarter was down the most in history, actually. And so we need the government stimulus. And in the past, the stimulus has always won out. And the question is, again, can they keep it up long enough to get a victory this time? I mean, I think they will continue. I think they have to continue. Then the question becomes what the long-term ramifications are.
Howard, you point out this historic decline in second quarter GDP. It's a subject you touch on in your memo. And as you point out, we here at Bloomberg and others reported that the decline in second quarter GDP was 32.9%. Of course, that was on an annualized basis. The nominal decline on a quarterly basis was much smaller, 7.2%. You go into this.
Yes.
And if you add it up in dollars, it's approximately $380 billion.
Right.
Why is that important? That difference between the 32.9 on the one hand and the 380 billion on the other?
Well, the real difference is between the 32.9 and the 7.2.
Yes.
I mean, alternatively, the decline was reported as being 1.8 trillion, and as you say, the actual quarter-to-quarter decline was 380 billion. So what accounts for this difference is that when the Fed reports, they report at what they call an annual rate. So they say that that GDP fell at an annual rate of 32.9% in the second quarter, and nobody stops to say, I wonder what they mean by that. And it as I say in the memo, Eric, and you know, it's a very complicated answer.
Well, it raises a question for me, and one I think you implicitly raise. If we're talking about an absence of $380 billion that might have otherwise existed, all things being equal,
right.
Did the government overreact, Howard, by throwing $6 trillion at a $380 billion hole?
Well, that's the $64 question, Eric. You could say, you could formulate it the way you did, and there's something about that. But on the other hand, you might say that, well, thank God they threw $6 trillion at it, because otherwise it would have been much more. You could say that the $6 trillion brought the decline to only 380 billion. And you know, there's no right answer, but it just goes to show you how much the government has had to do to respond to the effects of the economic shutdown.
I'm a big believer, Howard, as you know, that you can't really have it both ways. You're right that there is no precise answer to that question. We won't know for a while. And then, of course, it will be a matter of analysis. There's never a certainty to it. But do you have a gut feeling? Do you think $6 trillion, verging on 7, is too much? It's not
a matter of too much. One of the most important things, I mean, I believe that the injection of that kind of money, liquidity, into the economy is likely to have some long-term ramifications. And the most likely is some pickup in inflation. But that doesn't mean that it was a mistake. You know, the mere fact that you do something that has possible negative consequences doesn't mean it's a mistake. They had to do it. If they hadn't done the things they did, we would be talking about a much more serious economic event. Now we might even be using the word depression. Well, and the words global depression.
What we're talking about at the moment is largely a macro issue. Let's try to focus for a moment, if we could, on the credit markets. Howard, can government ever put the genie back in the bottle? Or is there now something of an irreversible backstop for all but the most unsalvageable of zombie companies?
Well, that's the question, Eric.
What's the answer?
Well, I don't know what they're going to do next time. Obviously, this time they're providing liquidity to all kinds of companies. Some of them are zombies. Zombie, we use that term in the markets to define a company where the cash flow is less than the debt service requirements. So in other words, they have to borrow money to service their debt because their operations don't throw off enough. That company is not doing well. If it's going to do that for long, it probably should go out of business. But the provision of liquidity now is keeping them alive. Another thing we say, however, is that the Fed can provide liquidity, but it can't provide solvency, which is to say it can't make a zombie company a moneymaker. but they can and are keeping companies longer.
So, which is to say, for the time being, these companies would not have survived were it not for Fed and Treasury action.
Many of them, yes. Yes.
Howard,
I mean, a great example is the airlines. You know, the airlines have tremendous ongoing costs every day, whether they're flying or not, and to ground the planes and have them go through a long period when they're not flying or when they're underpopulated, many of them would have gone under, and government grants kept them in business.
do you think, Howard, that we have crossed the line into state capitalism?
Well, state capitalism. I mean, we haven't passed the line into government ownership of businesses, but clearly there is an unwillingness to let companies go. There's an unwillingness to let the chips fall just anywhere, and you know, this period since March has been a period when the government has been providing revenues and incomes to people and businesses that they otherwise would not have had. They need. And without those, it would have been very serious consequences.
But there's a necessary Darwinistic quality to free markets that has been staved off for the time being. At what point is it right? Look, every credit investor is wrestling with this because you have to make decisions accordingly about, you know, how you think you're going to generate a return. It's fundamental in this equation. At what point does that need to start happening?
Well, look, you know, we use the term creative destruction, which is to say that the companies that are unsuccessful should perish. And it is, if we waste societal resources keeping unsuccessful companies in business, then we can't do, then there are other parts of the population or the economy we can't do as much for. And in one of my memos, you know, I said that fear of bankruptcy is to capitalism as fear of hell is to Catholicism. And it is fear of bankruptcy that keeps managements prudent and careful and trying to control the risks they take. If they're confident that the government or the Fed will keep them in business, even if they take big risks and lose a lot, then it introduces what we call moral hazard, and so much for prudence. Has
the Fed engendered too much moral hazard?
Well, you keep trying to use these words like too much and not enough, and
it's my job, right. Howard.
Well, they have, you know, it's a personal taste. They have crossed over to supporting. Look, in the past, the Fed buys a lot of securities. That's how they inject money. That's one of the ways they inject money into the economy. They initiated this thing called quantitative easing, QE, after the global financial crisis. But then they always bought government debt.
This brings up an important question. Right. As I'm sure you've seen, even CCC rated junk bonds, Howard, have recovered to their pre-pandemic levels.
Right.
Do you recall ever seeing a bigger gap between credit pricing and credit fundamentals?
No, I don't think so. I don't think so.
This is the biggest ever.
But you know, and by the way, the government has not bought many low-rated bonds. They maybe none. They've bought some low-rated ETFs, but they have created an environment of such prolific liquidity that companies have been able to stay in business. The other thing to bear in mind, though, Eric, is that when you say that the bonds have recovered to their historic highs, which means that the yields are at their historic lows. In bonds, the yield and the price have an inverse relationship. So the bonds are at the lowest yields they've ever yielded. But remember, or they have returned to their lowest yields in the past. But remember that interest rates are lower than they've ever been. So, you know, if you go back, let's say 2 years, the 10-year Treasury yielded 2. So a high yield bond might have yielded, let's say 7. And people say, oh, you know, it yields 5% more. That's worth taking the risk. Well, when the yield on the 10-year Treasury goes to almost zero, then high yield bonds can sell at yields of 4 and still look attractive, because everything in the investment business, all the decisions are made on a relative basis. So we say that the yield spread is what determines the relative attractiveness of different categories. And even though the yields are at the lowest of history, the yield spreads are still attractive because the base rate is so low.